Good evening, everyone. Welcome to Global Financial Consultants webinar titled Market Update with an Australian Overview. My name is Tiffany and I am the Marketing Manager here at GFC. Thank you so much for joining us and I hope you get a lot out from tonight. We will have the Q&A chat on, so at any point you have any questions, feel free to type that in the chat box and we will answer them at the end of the webinar. Please do note that the information in this webinar is of a general nature only. It does not take into account your individual financial situation, objectives, or needs. You should consider your own financial position and requirements before making a decision. Before I introduce you to our speaker for tonight, we will quickly give you a background about Global Financial Consultant. GFC is a financial advisory company here in Singapore. It was initially founded by Bruce Barron and Ian McMahon in 1997 back in Sydney, Australia, and they then relocated to Singapore in the year 2007. Since then, we have been helping all our clients with their financial planning, be it tax-effective savings or investments or any future financial planning such as retirement planning or education fees planning. We also help our clients with any term insurance, SRS investments, CPF investments for Singaporeans and PR, as well as pension transfers. We are regulated by the Monetary Authority of Singapore, and GFC's main aim is to build a long-term relationship with our clients by giving unbiased advice. Recently, Singapore's Finest had nominated GFC as one of the top 10 financial advisory companies here in Singapore. So that's a bit of background about GFC. Now let me introduce to you our speaker, Daniel Dal Molin. Daniel has been an expatriate for over 30 years, living within the Asia-Pacific region for all that time. And for the last 16 years, he lived in Singapore with his Singaporean wife and child. Daniel left his corporate role financing the supply chain and joined GFC about 2 years ago to help fellow expatriates to take advantage of the opportunity to save and invest in a low-tax environment. Before he became a financial advisor, Daniel has been a client of GFC for over 10 years. So over to you, Daniel.
Hi, everyone. Thanks very much for joining us tonight. We have a short presentation on just general market conditions and what's going on around the world. And also we're going into a little bit of detail about the Australian property market and some other avenues for investments. And now the Australian market update. GDP is growing well in Australia for the year to date. We are still up 3.2%. Inflation has not seen the highs as in the UK or the US, and at the moment it's at 6.1% print in quarter 2 from 5.1% in quarter 1, which may show that this value may increase again in quarter 3. The RBA's target cash rate is at the moment 1.85, and I do expect there'll be some increases to go. Unemployment is at historical lows of 3.4%. The Australian Stock Exchange last week was up 2%. I think we've come off a little bit this week, but we're down 5% year to date. Australian dollar to Sing dollar exchange is about the same from the beginning of the year to now, while the Australian dollar US dollar has dropped a little bit from, should be 69 cents to 72 cents. Australian property market. So just a little bit of detail. There's a lot of news in the press about the Australian property market, as there is been with the US property market. I'm reading and understanding that Sydney and Melbourne were the first markets to move negative, which was in the last quarter of last year. I think they had a steamroller 2 years. Very strong markets in Australia. Later on, there's Adelaide, Brisbane, and the Gold Coast have followed the market down in the last 2 months. Highly reliable sources are saying that some markets in Australia may end up 10 to 15% off their highs and back to the 2020 levels, which is probably a little bit more stable. I feel that with the cost of living increases in Australia, people are careful before committing to large purchases at the moment, and will wait and see before their next large purchase. I think people are wait and see. That's why there's been a decline in sales volume. And interest rates are probably starting to bite those people that got into the market late. Having said that, there are signs, having said that about the market in general, there's signs the top end of Sydney and Melbourne remain very strong. Unit prices across all cities are doing better than house prices. The rate of growth in property prices this year has slowed as fast as it has, as it did in the lead up to the 2008 financial crisis. So it's slowing down very quickly. We'll have to see in the next quarter or two what happens. Expectations over the balance of the year and into next year expect that the number of sales and prices will continue to slow over time as buyers dry up in the market and consumer confidence is a bit under pressure. This is the latest CoreLogic graph as to cities in Australia and what's been happening in the first half of the year. Sydney's off just in the last month of July is off minus 2.2%, and in the quarter almost 5%. Melbourne's off 1.5%, in the quarter 3.2%. Adelaide and Perth are still up a little bit. Hobart's down, Canberra's down. Capital cities combined are down 1.4% and 2.6% in the quarter. National market is down 1.3% and minus 2% overall for the quarter. So those numbers, interesting to watch next month when we do another webinar. We will bring up the latest data as well. The good sign of the property market is rentals have increased across the country, with July showing that aggregate rental increases for units up 10% and for houses by 9.5% in July. So unit rental increases are growing faster than house rental increases. This has been helped a little with the higher number of properties listed on the short-term rental market. So there's a lot of properties in Australia on the Airbnb and similar markets. Currently, there's about 12 or 13,000 properties listed on Airbnb. I have a lot of clients coming in at the moment and discussing or asking me that they're thinking about taking the opportunity of the low Australian dollar and declining house prices to purchase another property in Australia. As a general rule, I feel that we need to consider a few points before we rush out and buy another property. I think we need to have a consideration as to why are we buying it. Are we exposed, underexposed, or overexposed in the Australian property market? And I think it's important to think about final returns. If you're buying the house for investment purposes, or you're planning to go back next year, so you're buying a house this year, settle, maybe renovate, move back in next year. Please consider carefully. So are we planning to buy a property now? So the question is it a form of investment, or is it going to be used now or later, or when you return back to Australia? There are a few tax implications in the decision to buy property in Australia today. Number one, major tax consideration, I believe, is capital gains tax. As a purchaser of property in Australia, if you have an Australian citizenship or you are an Australian resident, permanent resident, yes, very easy to buy property in Australia. But if you are staying overseas and you may have to sell that property in future before you return back to Australia, then you need to consider your options, because if you're a non-Australian tax resident and you sell your property while you're overseas, you will be charged the top marginal tax rate on that gain. It's very important. I know there's some people that are buying property at the moment because they anticipate that they will go back in the next few years. I think that's great. But if you're buying property for an investment, but you're not sure when you're going to return, you need to consider. The other issue that I find with property at the moment is land tax. You've got two states in Australia that have taken advantage of their hot property markets to impose higher taxation on land. So at the moment, we have New South Wales. They have a 4% surcharge that starts in the next financial year on top of the standard land tax calculation for owners that are considered not Australian citizens or permanent residents. And there is no tax-free threshold for those people. In Queensland, they are using the base value of all your properties in all states in Australia to calculate the base value and thereby avoiding any tax-free threshold for your value of your Queensland properties, of which they will tax. So they will take the value of all your Australian properties, add it up together, and then they will use a calculation to impose a tax on your property. But generally that means that you don't have any of the tax-free threshold anymore, and you're paying a much higher amount of land tax. The other point I want to raise tonight is that with rental increases, you saw before that unit rentals are going up 10% and house rentals are going up 9%. So everybody's earning a little bit more rental, but you must remember, as a foreign non-resident, you'll be paying 32% on your net rental income. So if the capital gains, if you're buying to keep and you're leaving it there as an investment, you might not be attracting capital gains tax because you might sell later when you move back to Australia. But certainly if you have a house or a large apartment, you'll be attracting land tax and you'll be attracting rental income tax. So step carefully, please. I've been asked a few times, Daniel, what about if we don't buy a property back home for investment or another property back home for investment? What should we do? So the other options, if you want to invest in another asset, we call it, what investment options do we have outside of property? So one is an insurance bond. An insurance bond are an option to add to your investments that can provide a tax benefit to you. These products are made for Australian clients that will hold these investments for greater than 10 years. The principal and the gains from investment can be paid to you in Australia later on tax-free, as long as you hold these investment bonds for 10 years or more. Even if you travel back and live back in Australia, they get paid out tax-free. So maybe if you're looking for exposure to the Australian property market, but don't want to own any property directly, you can purchase through an insurance bond REITs, Australian REITs, which are property trusts. These are shares usually traded on the Australian share market, and you buy these through your insurance bond. So you are taking a exposure to the property market, inserting it into insurance bond, and you're picking up any gain later on after 10 years tax-free. So if you're looking for a structure that can be tax beneficial to hold these shares, maybe consider this insurance bond. Other people have been saying recently, I have a few, I have some spare money, maybe I just put it back into my superannuation in Australia. So some clients do opt to invest surplus money back into their superannuation accounts in Australia as non-concessional contributions. Without seeing exact details, I have to have a look. Some people can invest up to $330,000 of non-concessional contribution drawn forward. But I just want you to consider the difference in tax rates inside a superannuation, inside your superannuation versus an insurance bond. So if I'm going to make an employee contribution with after-tax income in my superannuation, I will insert that money. Yes, I won't attract anything up front, but from then on, any employee contributions will be 15%. Interest income will come in at 15%. Assessable tax capital gains, that means any capital gains that you've made inside your super fund with assets that have been owned less than 12 months will be taxed inside your super at 15%. Dividends income, which are inside your super, also taxed at 10%. Any capital gains for assets inside your super that you hold more than 12 months, we taxed at 10%. Now, if we have a look at an insurance bond, personal contributions into insurance bond with tax paid money, 0 rate. Employee contributions will be at your rate of tax that you're paying in the country of residency. Interest income, 0% tax. Assessable capital gains tax, assets less than 0% tax rate. Dividends, 0. Assets on capital gain on assets that are more than 12 months in ownership, 0%. So the option of putting money back into superannuation versus putting money into insurance bond, superannuation when you go home, yes, after 60 years old, you'll be drawing income or account-based pension with 0 income tax. Insurance bond, you can draw money after 10 years, regardless of your age, tax-free, as long as you hold it for 10 years. So we do try to advise clients that there are taxes that are charged to their super accounts in the form of dividend, income tax, and capital gains tax within super. Please be careful. Conclusion. I think tonight's discussion, I think there's evidence that shows that the US economy, although it's slowing down, will continue on its growth path in the next 12 months. And people are talking about the S&P 500 reaching a new high maybe spring next year. In Australia, we call it the lucky country. The economy seems to be doing very well, and we have all the resources in Australia to help the world transition to a carbon-free future. With markets off their highs, maybe time to add some extra spare funds into the market, I think. With the low Australian dollar and property prices on the decline, there is a lot of incentive to invest back in the property market in Australia. But we need to consider which states we are purchasing in and what are the tax implications for you, as most property investments are there for the long term and there's tax implications. Consider other places to invest your spare savings, including superannuation and insurance bond, but be aware of the tax differences. Tiffany?
Thank you very much, Dan, for a great presentation. It's very insightful. So
Stop share?
Yeah, sure. Why not? So people can see your face.
All right.
So there are some questions that came through. So the first one is, are there any risks going forward with regards to investing further in funds, like further funds into superannuation?
Yeah, I think the issue today is that the current federal government is talking about not increasing the transfer balance cap. So recently when the Liberal government imposed the transfer balance cap of $1.7 million, there was an understanding that each year they would increase this transfer balance cap by 100,000. So as investments, if you've got $1.7 million of investments, it's done quite good over the last year. That 1.7 is now 1.8 million. That's outside the transfer balance cap. So it does cause problems for your super. Listen, the Labor government hasn't made any decision at the moment, but this is the rumor. I think let's wait and see.
That's good. So for the next question that we have, what is the upside in investing in property today?
Currently, I think the upside is that rentals are increasing. It's interesting to see unit rentals increasing faster than house rentals. It's been a little bit inverted over the last 5 years. But as you know, as you earn more rental income and you've got the same fixed costs and interest costs, your exposure to net rental income tax is 32% because we are foreign residents. So need to be very careful there and plan your dollars.
Okay, thank you. So the last question that we have for tonight is, are the investments through insurance bonds popular?
Yeah, I think with expatriates, they are very popular. We do a lot of insurance bonds here in Singapore for expatriates that are based in Singapore. It has an opportunity for them to invest in insurance bond for the long term. And once in Australia as a worker or retired, as long as you have kept the insurance bond for more than 10 years, you can withdraw these funds as a lump sum or as a monthly payment, tax-free. They're not really attractive for local residents because they have different tax implications. So it's really something that people have the opportunity, if they're offshore, to invest in while they're offshore, and then move back onshore. They can still keep that insurance bond, but they can't invest in an insurance bond while onshore. It just doesn't make any sense from a taxation point of view.
Okay.
Yeah.
Thank you very much. That's all the questions we have for tonight. So thank you all for coming. If you have any questions regarding your own financial planning, your own financial situation, or you want to talk to Daniel further about either property, insurance, bonds, or just general market, you can email him at daniel.dalmolin@gfcadvice.com, or just give him a call or a text, or find him on LinkedIn. So thank you very much for coming
Thanks.
tonight. Thank you, Dan, for a
Thanks
very
very much,
insightful
everyone.
presentation. Yeah, thank you very much.
Thank you.